Hello everybody, welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Robert Half, which is listed as Half Robert, which keeps throwing me off up here on the vast graph. Ticker RHI. As always, this is not individual investing advice. This is just how I analyze stocks. If you have a request you would like me to analyze on the channel, just put it down in the comment section. I'll get it on the whiteboard behind me, which I just finished up one of those long columns, so I'll be able to erase that off there. And I'll make a video for the YouTube channel. If it's a stock that's in the S&P 500, like Robert Half is, I post those on YouTube for free, and the rest I post on Patreon. Those links will be down in the description. If you do join the 5-tier level at Patreon, you can get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And that's where I have all the spreadsheets and chat rooms and everything, where you can contact me directly and do all those sorts of things. All right, let's take a look at Robert Half. So as usual, I start by looking at the historical earnings cyclicality. So that's the dark green shaded area on this fast graph here. And we can see that during the Great Recession, earnings fell over 85% because they fell that year too. We can shorten this so I can see it a little better. So 10%, then 85%. So somewhere in between 85 and 90%, earnings fell from peak to trough on an annual basis. So that is deeply cyclical during that downturn. And then we have some more evidence of deep cyclicality during the COVID shutdown for sure. And then we also see that happening after the COVID boom. So the COVID bust is now occurring. And the stock is significantly off its highs, about, we'll call it 45% off its highs during the current earnings and stock price decline downturn. So you can see why someone might ask about this one. They have a history of generally rising earnings peaks and troughs, which is what we want to see with the cyclical. We want this peak to be higher than this one, and this one to be higher than this one, and this one to be higher than this one. And then preferably, really the peaks are probably the most important, but it's nice when the troughs are higher as well, which they certainly are. The troughs don't have to be, and given that this 2020 downturn was kind of a weird and partial downturn, it wouldn't necessarily predict that this downturn would be higher than that one. It could definitely be lower if earnings fall 90% off of 2022's highs. So what were let me see if I can get them listed here. You have to shorten it to see each individual year. A little bit more. There we go. So $6 a share. So you can, you think like 90% less than that would be, under $1 per share. If earnings fall that much, then the stock price will likely fall as well. But the earnings can fall a lot more if they fall the same percentage amount that they fell in the past. Obviously, this is just a rough guide, but at least what it does is it gives you, it's very important, especially during like a spike like this, during an upcycle, to understand that it's pretty normal for these type of fluctuations to happen, and then that the stock price could fall deeply as well. So once we've established that the business is pretty high quality because of this generally rising earnings trend, earnings recovery time also took about 4 years for them to recover from the bottom of the 2009 decline, to make new highs again, and then they recovered within 1 year during the COVID decline. So the recovery periods look pretty reasonable. Usually I like to see those within like 5 years from peak to new peak. So I think this one might be 6. 1, 2, 3, 4, 5, 6 technically. But that's still pretty close. I mean, you would still do well if you were buying the stock down here and you held it for 5 years, right? So all the basic setup looks good for potential deep cyclical investment. So now we want to know, how far has this stock typically fallen in the past off its highs? So you can see I have it labeled as a deep cyclical. And these are just some rough, well, it looks like I might have done them a little bit more exact here on these previous downturns. So the 2001 downturn, the stock price fell about 68% off its highs. In 2008, it fell about 67%. And then in 2020, even though it was kind of a truncated decline, it fell 57%. So we get some evidence that even in recent times, that the stocks, nothing too much seems to have changed in terms of the way the market treats the stock. So what does that tell us? Well, that tells me that, and currently is down 45%, so we have the pattern happening again. That tells me that if you aim for about 65% off the highs, that is likely to, one, hit during a recession, and two, get you relatively close to the bottom. Now, with cyclicals, there's a big variety of things that can happen, and there can always be other circumstances that come along that make it difficult for them to recover or maybe never recover. But you can usually get the odds on your side. Like, if with this particular setup, like 80% of the time, you're going to get that full recovery in about 5 years and do really well with the stock if you buy it that cheap, if you get the opportunity. So, but 20% of the time, they might not. They might be permanently disrupted. Maybe AI or something comes in and really hurts whatever the sort of business that they have. That's typically been the, I think this is outsourced services, right? That's typically been the threat that the market thinks could be there. So we don't know that. And so the way that I account for that potentiality is to take small positions. So I'll take like a 1% portfolio position, because these stocks can move a lot, and the fundamentals are not going to be a good representation of the potential. The fundamentals most people use are not going to represent the future returns very well for stocks like this. So if you go back here, let's say this would have been a good time to buy the stock. The PE was 60, right? So that looks unattractive. But if you bought it and you held, let's see, this downturn actually started here, and you held up it toward this peak, you would have had a 200 and almost 50% return. And that wasn't at the bottom, right? The bottom was down here, but the PE was 60. Well, why is that? Because earnings were in a trough, so it inflates the PE. So you want to be the person that understands that and that can invest here, and you can get that big return over quite a few years just by understanding the cyclicality of the business. So let's say this stock price, the PE is 20 here. If it to recover here, and earnings were still down low, you would see that really high PE ratio. You want to totally ignore that in this case. But they can fluctuate a lot, the prices of these. So if we go back to like even this downturn, let's say somebody bought here. They bought after, this is maybe like a 20% decline. Let's see. 32% decline. Let's say, okay, they bought here. Well, at the trough, they still would have been down another 35%. So even if you think you're buying at a pretty big discount to the price, to the valuation, they can fall further pretty quickly. And it just takes one bad news event. So this is why I take small positions when I'm buying a stock like this. There's my neighbors have the lawnmower guys over there, it looks like. Okay, so what are we at for a buy price here? So I'm aiming for 65% off the highs, which is putting the current buy price at about $44. And so the stock still needs to fall about another 37% for me to consider buying it. So that's kind of where I'm at on here. And I think if I didn't have any, I don't have any other stocks like this, I might take a chance on this one. It's a little bit, looks like a little bit more higher quality. If I was only going to pick one or two out of this industry, out of their general industry, this would probably be one of them. So that $44 spot, it looks like they're just under $70 a share, is where I would be aiming to add a position. And then I would probably, I mean, if you buy a stock when it's 65% off its high, you should be able to get like a 200% return, just about. So, because you think of a $100 stock goes to $35 a share, you buy it, it doubles once, it goes to 70, it doubles again, it goes to 105. So you'd be aiming for like a 200% return. So even if it took 5 or 6 years, you would still get very good results in the end. And that's the sort of entire setup I would like to have for a stock like this. Okay, if you found this useful, hit the subscribe button, hit the like button. If you have a request, put it down in the comments section, and I'll see everybody later. Bye.